People get really sentimental about the rupee. I learned this the hard way. A couple of weeks back, I posted a video on what's going on with the rupee, and rather naively, I thought that this isn't going to be controversial. After all, this is pretty straightforward market economics. But boy, was I wrong. The comment section got fired up. I'll leave a link to the video in the description. Do watch it in case you haven't. So why were people disgruntled? For one, many thought that this explanation that a strong dollar is causing a weak rupee is a conspiracy theory of sorts. They were like, sure, at the time of Manmohan Singh, BJP was shouting off rooftops that weak rupee, weak economy, and now when it's happening in BJP's time, all these YouTubers and news panelists are busy saying it's not the rupee, it's the dollar. Linked to this is the strong belief that if the currency is depreciating, then it is definitely because the economy is performing badly. Others believe that if India is a net importer, why should we care that a weak rupee may be good for our exports? After all, a weak rupee means expensive imports, particularly more expensive oil imports, so that will lead to inflation rising sharply. And so the conclusion from all of this seemed to be that, of course, the RBI should do all it can to intervene and stop the rupee from falling so much. How dare you suggest otherwise? And when I browse through other videos on YouTube on the rupee, I see similar comments, which leads me to think that these views might be more broadly held by the public. And look, they are very valid arguments. And let's face it, the rupee has indeed routinely been used and abused by politicians in India across the spectrum. Rupee girte hi ja raha hai. One small line, but so potent in conveying the mental image of a country in deep decline. And so, whichever party is in the opposition, they milk this sentiment to the hilt. Yes, a currency will of course depreciate if the domestic economy is tanking, but it also reacts to global economic conditions. And yes, sometimes both happen at the same time. And allow me to blow your mind even further. Sometimes countries purposely keep their currency weak. RBI routinely does it. You can see in this chart from a recent RBI research paper that whenever foreign portfolio flows have been entering into India on a net basis, so the blue line, whenever it is above the x-axis, so these are times when the rupee had a chance to appreciate. The RBI would step in, purchase those dollars, which is denoted by the red bars jutting up. So when you're vacuuming out those dollars which are entering the country, yes, it shows up as higher forex reserves, but simultaneously, as a central bank, you're denying the rupee the chance to appreciate. So what people see when they look at the chart of the rupee is one mega uninterrupted slide, as if something grave has happened. But the fact is that a lot of factors are involved, including self-sabotage. But politicians won't talk about these nuances. And by choosing to highlight only the side of the argument that appeals to their narrative and to their base, they have essentially botoxed the rupee debate beyond recognition. Not to mention that even Godmen and Babas seem to find the self-confidence to comment on the rupee. And so, right off the bat, let me put this out there. To all those saying, how come the BJP was so critical of the rupee when Manmohan Singh was the PM and then suddenly discovered economics when rupee is falling under Modi? Yes, you are right to point out that hypocrisy. And if this was a political video, then we are actually done. No further analysis needed. But since you are on this channel, I am assuming that you are interested in more than just empty political rhetoric. So let's take a moment and depoliticize the rupee and talk about it more objectively. Is the weak rupee currently really caused by a strong dollar? Well, don't let me tell you. Have a look at the data yourself. Look at how much the dollar has appreciated since end September 2024. It's gone up by around 9% at the time of filming this video. And that's primarily because the US has been doing well. There are concerns of how much Trump policies could disrupt emerging markets, all of which has led to higher US interest rates and a stronger dollar. So, dollar has gone up by 9%. And if rupee weakness was exclusively due to India-based factors, then surely other currencies like Chinese yuan or Indonesian rupiah or Vietnamese dong shouldn't be depreciating. But that's not the case. Not only have they also fallen against the dollar, but turns out that India has fallen the least among them. But that said, there are India-centric factors too at play. After all, India's growth momentum is slowing. We've done a detailed video of this on the Bond Economist. I'll leave a link in the description. And of course, that is impacting investor sentiment on India relative to other investment destinations. Also, people are suspecting that after months of the RBI aggressively draining away India's forex reserves to stop the rupee from depreciating, it is now coming to the realization that the fight is no longer worth it. So it's becoming like Elsa in Frozen saying, let it go. So now markets are betting for the rupee to be more flexible and hence react more to a stronger dollar because the RBI's dam has, so to speak, been breached. And look, you may hate BJP, you may hate Congress, but your politics can't change the economics on the ground. Hello and welcome to the Bond Economist, your one-stop destination for professional advice on the economy. My name is Auradeep Nandi, and today we try to clear some popular misconceptions surrounding the rupee. Like, how bad is a weak rupee for inflation? How bad is it for growth? What's really stopping the RBI from keeping the rupee stable? As always, if you like what you see, please hit like and subscribe. And if you'd like to contribute, feel free to scan the QR code on your screen or use the Super Thanks button below. First things first, let's talk rupee and inflation. Now, a lot of people will say this is a no-brainer. India is a net importer of goods, so a weak rupee means that things are going to be more expensive. So, of course, inflation is going to pick up. But let's unpack this a bit because it's important to understand exactly how much of India's consumer basket is actually impacted by the rupee. After all, services like, say, hair salons, tailors, watchmen, which are all, by the way, legitimate parts of India's consumer price index basket, are, of course, not traded globally, so have nothing to do with the rupee. Services are roughly a quarter of consumer price index. So this is the basket of goods and services whose price the statistics ministry regularly tracks. What about food? That's around 47% of the overall basket. Well, India is a massive agricultural producer. So a lot of our food items are domestically produced. So we are not like, say, a Singapore or a Maldives or some European country that lacks agricultural lands and hence needs to import most of its food. Our major food imports are typically edible oils and pulses. And here too, more than the rupee, what really matters for prices is whether the government allows exports or imports. The ability of farmers to export abroad or face competition from imports is heavily regulated in India by the government. Sometimes the government bans exports, as has been the case with rice or sugar, to prevent domestic prices from rising, because domestic supply increases if exports are not allowed. And sometimes the government discourages imports by raising customs duties, like it's done on edible oils. This is to appease farmers and to protect them from global competition. But that in turn means higher prices for you and me, the consumers, not just on edible oils, but also on other food items and restaurants that use edible oils as inputs. Arguably, these interferences by the government, sometimes on behalf of consumers, sometimes on behalf of farmers, have a more outsized impact on your food grocery bill than a small drop in the exchange rate. Now, of course, you can say, okay, Auradeep, we understand all of this, but what about crude oil? Don't we import oil? Wouldn't that get more expensive? Yes, you're right. India is a major importer of crude oil, and a weaker rupee does mean that we have to spend more to buy the same amount of oil. Not to mention that the dollar price of crude oil has also been going up thanks to recent sanctions by the US against Russian oil. So you may think, there you go, we now have to deal with higher petrol and diesel prices. In theory, you're right. Because in theory, petrol and diesel prices in India are deregulated. They should rise and fall based on the cost of procuring the crude oil. But in practice, you may have noticed for the past couple of years or so, there has hardly been any change in the price that you have been paying at petrol pumps. Is this because oil prices haven't moved at all? Not really. So, we've done a video on this on the Bond Economist some time back. I'll leave a link in the description. The government essentially leans on oil marketing companies saying, and by the way, these are essentially public sector companies. And they are told that, look, we require you to keep petrol diesel prices unchanged, even when crude oil prices are high. We understand you will be making losses, but don't worry. To compensate you, when global oil prices fall, we won't ask you to lower petrol and diesel prices. So lose money now, but make money then. And if that's not enough, we'll pay you for your losses from the union budget, which, come to think of it, is an elaborate way to give fuel subsidies. So again, the impact of a rupee may not be felt at the petrol pump, and by extension not be felt to consumer price inflation if this strategy continues. And what about other manufactured products? Surely the price of a pressure cooker or a mobile phone or a car or a shirt would be impacted if the cost of the inputs imported become more expensive? Yes, but here's the interesting fact. Core inflation, which is inflation X food and fuel, has come down sharply. Okay, so let's clear something up to begin with. A product or a service goes from 100 rupees to 120 rupees in a year. That's 20% inflation. Next year, suppose it only goes up to 125 rupees. It's a little over 4% inflation. Now, in your mind, you are paying 125 rupees now from 100 rupees 2 years back. So it's a big hit to your disposable income. But for the government and the RBI, and come to think of it, even markets, they are seeing inflation drop from 20% in 1 year to 4% in the next year, and are essentially taking decisions based on that. So why is core inflation falling? Now, it can fall if raw materials and inputs that companies use have become cheaper. But if you look at commodity prices globally, that's no longer the case. The other reason could be that this is a sign that Indian consumers are struggling. There is weak domestic demand, so companies are reluctant to raise prices in fear of losing customers. Or it could be that companies are facing pressure from dirt cheap imports from China, where economic problems of their own are reported to be encouraging Chinese companies to dump their goods at ultra cheap prices to countries like India, thereby undercutting Indian companies. Whatever be the reason, the point is that core inflation currently is exceptionally benign. So, look, I can understand the rupee being a threat to inflation if core inflation was high, and if overall inflation was averaging something crazy like 9% or 10% like it did in 2012 and 2013. But now it's in the 4 to 5% range. RBI's own calculations suggest that every 5% depreciation of the rupee leads to a little over 0.3% increase in overall inflation. And the rupee so far is depreciated by only around 3.5% or so. So if you do the math, that's like 4.5% inflation becoming maybe 4.7%, max 4.8%. So, I could be wrong, of course, but the rupee so far doesn't look like it will disrupt inflation the way most of us might be imagining. But what about the impact on other aspects of the economy? Well, a weaker rupee, of course, makes imports more expensive. It makes our exports cheaper. Now, some imports are understandably unavoidable. Prime example, crude oil. So a weak rupee will definitely increase the import bill of the country. But is that a risk to our external sector? See, we run a current account deficit, which means that we import more than we export and more than we get in remittances. So on a net basis, we are always leaking dollars. We fill this leak with foreign investment in our markets and our companies and other forms of foreign capital. So is the weak rupee going to blow open India's current account deficit leak? Well, not really. See, India's current account deficit is currently tracking around 1 to 1.3, 1.4% of GDP. These are low levels for India. Things get serious when current account deficit widens to around 3% of GDP, because then we are like, this hole might be getting too big for foreign investments to plug. Things are really out of control when you are in the 4 to 5% of GDP range, as was the case in 2012 or so. So on the current account side, of course, a weak rupee adds to pressures, but the levels are under control right now. And by the way, not too many people catch this, but a fully flexible currency acts as an automatic stabilizer of sorts, like a car suspension. So if the currency depreciates, first, the country's import bill goes up, but then people start to reduce their demand for some of the imports. So say you're planning to buy gold or a luxury item or an iPhone that uses foreign made parts, or say you were planning to go on a Europe trip, influenced by some Instagram butterfly, but now a weak exchange rate might be putting you off. So once you reduce your demand, the country's imports start to go down. Simultaneously, for some exports, the weaker exchange rate is a positive. especially if the rupee has also depreciated against its other trading partners. RBI's estimates suggest that accounting for inflation, the rupee still remains overvalued by around 7% when compared to its major trading partners. So actually there's scope for more depreciation to help our exporters. So the trade deficit, imports minus exports, first it picks up as imports get more expensive. But then the volume of imports start to fall and exports receive support. So the trade deficit can slowly improve, which is positive for GDP growth. GDP is consumption, investment, government spending, and net exports. Exports minus imports. So growth improves when net exports pick up. And by the way, don't underestimate the power of an incentive to exports. Exports are crucial to India's employment, be it the IT professional in Bengaluru, or a worker in a mobile factory in Tamil Nadu, or a car factory in Maharashtra, or someone working in a diamond factory in Surat, or a leather unit in West Bengal. They're all reliant on exports. Not to mention the impact on the economy that these employees generate around them, like household helps, hotels, restaurant, taxis, bus, etc. The RBI estimates that every 5% depreciation in the rupee eventually causes GDP growth to increase by around 0.25%, which means if growth is expected at say 6.5%, then the rupee depreciation can push it up to 6.7, 6.8% over time. That said, in economics, as much as the end result is important, how you reach there is also immensely important. So, a rapid depreciation of the rupee can also be destabilizing. Firms that didn't hedge their currency exposures could end up making huge losses. Those who have borrowed a lot from foreign markets will suddenly face much higher interest outgo if the rupee depreciates too much. And if this happens on a large enough scale, that can disturb overall financial stability in the country. So a rapid depreciation is going to be disruptive, regardless of whether it helps growth later or not. Which begs the question, if the rupee is indeed so disruptive, why doesn't the RBI simply control it? People, meet Impossible Trinity. Impossible Trinity, people. This is a very popular theory in economics and basically tells you why it's so complicated for a country to peg its currency or try to keep it stable. So what the Impossible Trinity tells you is that at any point of time, you can have only two of these three things. One, exchange rate stability. Two, independent monetary policy. That is the flexibility to increase or decrease interest rates according to domestic inflation and growth. And three, free mobility of capital. So basically allowing foreign investors to bring in and take out their money whenever they want. You get to choose only two out of these three. You can't have all three. Why? Well, suppose you want to keep the exchange rate stable. And because you don't want to freak out your foreign investors by trapping their money, you say that, all right, let's keep free capital mobility. They can bring in and take out their investment at their will. So you have chosen stable exchange rate and free mobility of capital. Well then, congratulations, you have just let go of control over your interest rates. Because what happens if tomorrow growth slows in India? You can't reduce interest rates. Because if you reduce interest rates, then guess what? That foreign capital that you have chosen to keep free of any restrictions will see that interest rates abroad are higher and will exit India. And when they exit India, they will dump the rupee, it will depreciate, which means that your exchange rate will no longer be stable. So if you want the stable exchange rate and you don't want to restrict foreign capital, well, you can't afford to have an independent monetary policy. By the way, this is what has been playing out in India lately. So when people were waxing eloquent about the previous RBI governor, Shaktikanta Das, keeping the exchange rate stable, what he was basically doing was playing around with this Impossible Trinity challenge. So Das wanted stable exchange rate. He couldn't do anything about capital controls, which are largely, although not fully, unrestricted in India. So what he ended up doing was sacrificing monetary policy independence. Even though growth was slowing, even as core inflation was falling, Governor Das maintained that nope, we can't reduce interest rates. Of course, no governor will tell this explicitly because the mandate is flexible inflation targeting, which means that the RBI is allowed to change interest rates only in reaction to domestic inflation and growth, and not other factors like, say, exchange rate manipulation. So he kept saying things like, look, food inflation is so high, we can't cut interest rates, even though that doesn't make much logic. Or that, look, growth is so strong, interest rate cuts are not needed, even though the RBI's forecast of 7.2% GDP growth in FY25 was wildly unrealistic. Advanced estimates now by the statistical agency show that growth is much lower at 6.4%. So traders, investors in the bond market were watching these things, and they concluded that on paper growth and inflation matters for RBI's monetary policy, but in practice Das was hypnotized by the rupee. So lately, when dollar sharply picked up and the rupee tanked, the RBI went back to its stability fetish and started selling dollars, creating a scarcity of rupees and stopping the rupee from depreciating too much. That scarcity of rupee has hit the domestic money market, which has caused short-term interest rates at which banks lend to each other to spike up. And I don't think people realize how bad this is. I think it's easier for them to visualize weak rupee causing inflation. But make no mistake, interest rates going up from 6.5% to 7% in defense of the rupee is also hitting you through higher cost of credit and by applying brakes on growth. And for what? To give people the illusion that all is well with the rupee and with India. But even that strategy is faltering, because as India's forex reserves slide and the dollar continues to rise, there is a limit to how much the RBI can keep up this charade of a stable currency. So now the unwind is happening. RBI under the new governor, Sanjeev Malhotra, is taking measures to inject money into the system that has been starved of liquidity thanks to these maneuvers, and is trying to calm down interest rates, which also means letting go of the rupee, treating it like an adult rather than a moody teenager being locked in their room. For more such insights, like, share and subscribe to The Bond Economist.